Saturday, March 16, 2013. 6 a.m. Cyprus. Cypriots woke up to news that shattered the fundamental assumption of modern banking. Your deposits are safe. The government had announced overnight that bank accounts would be taxed directly, not income, not property. Bank deposits themselves, money already in your account, would be seized to pay for a banking crisis you didn't cause. The details were shocking. Accounts under 100,000 euros would lose 6.75%. Accounts above 100,000 would lose 9.9%. If you had 200,000 euros in Bank of Cyprus, Friday night, you woke up Saturday morning with 180,200, 19,800 euros simply confiscated. No warning, no vote, no appeal. The banks didn't open Saturday, they wouldn't open Monday either, or Tuesday, or for the next 12 days. When they finally reopened on March 28th, capital controls were in place. You could withdraw 300 euros per day. That's it. If you had €1 million in your account, after the haircut took 9.9%, you could access 300 per day. Your own money, locked behind restrictions that would last months. This wasn't a bailout, this was a bail-in, and it established a precedent that would echo through every banking crisis afterward. When banks fail, depositors don't just lose their money to bank runs, they lose it to government confiscation disguised as policy. This is the story of how Cyprus became the testing ground for a new kind of financial crisis resolution. How depositors, people who thought bank accounts were safe, became creditors forced to absorb losses. And why what happened in Cyprus in March 2013 created a blueprint that's now official policy across the developed world. Understanding Cyprus matters because it proved governments will confiscate deposits when banks fail. The tools used in Cyprus, bail-ins, capital controls, bank holidays, are now legal frameworks in the EU, UK, US, and beyond. Next time won't be an experiment, it will be protocol. Cyprus in early 2013 was already in trouble, though most Cypriots didn't realize how bad. The island nation had joined the Eurozone in 2008, adopting the euro and gaining access to European financial markets. This seemed like progress. It was actually the setup for disaster. Cyprus's banking sector was massive relative to the economy. Bank assets totaled roughly 800% of GDP. For comparison, healthy banking systems are typically 100 to 200% of GDP. Cyprus's banks held 8 times the country's entire economic output. The system was grotesquely oversized. Why so large? Russian money. Cyprus had positioned itself as an offshore banking haven for Russian oligarchs and businesses. Low taxes, light regulation, EU membership providing legitimacy. Russian deposits flooded into Cypriot banks through the 2000s. By 2013, estimates suggested 20 to 30 billion euros of Russian money sat in Cyprus banks. On an island with GDP of 18 billion euros, the Russian deposits alone exceeded the entire economy. The banks didn't just hold these deposits, they invested them aggressively. And their largest investment was Greek government bonds. Cyprus and Greece share language, culture, history. Cypriot banks saw Greek bonds as safe, familiar investments offering decent yields. By 2012, Cypriot banks held roughly 22 billion euros in Greek government bonds. This was catastrophic exposure. When Greece's debt crisis exploded in 2010 to 2011, those bonds became toxic. The Greek government couldn't pay. Restructuring was inevitable. And in March 2012, Greece imposed a voluntary debt restructuring that was anything but voluntary. Private bondholders, including Cypriot banks, took a haircut of approximately 53%. If you held 100 euros in Greek bonds, the restructuring gave you 47. The other 53? Gone. For Cypriot banks holding 22 billion in Greek bonds, the math was brutal. The restructuring wiped out roughly 12 billion euros. That's 12 billion in losses, absorbed directly by banks that held 800% of GDP in total assets. The losses were catastrophic relative to the capital base. Cyprus's 2 largest banks, Bank of Cyprus and Laiki Bank, were essentially insolvent. But they didn't close. They stayed open. Why? Because closing banks triggers panic. Bank runs, contagion. The Cypriot government hoped to find a solution quietly, request a bailout from the European Union, Recapitalize the banks with European money, avoid disaster. By early 2013, it was clear Cyprus needed help. The banks couldn't survive without capital injections. The government couldn't provide that capital. Cyprus's GDP was only 18 billion euros. They needed external support, so Cyprus formally requested a bailout from the Troika, the European Commission, European Central Bank, and International Monetary Fund. The Troika's response was harsh. They would provide 10 billion euros. But Cyprus had to contribute. The Troika demanded 5.8 billion euros from Cyprus itself as a condition of the bailout. Where would Cyprus find 5.8 billion? The government didn't have it. Raising taxes wouldn't generate that much quickly. Selling assets wouldn't reach the target. The solution the Troika proposed was unprecedented. Tax bank deposits directly. Take money from depositors to recapitalize the banks. Make the people who trusted the banks pay for the bank's failures. This was the origin of the bail-in concept applied to ordinary depositors. The initial proposal leaked March 15th, finalized overnight March 15th to 16th. Saturday morning, March 16th, the Cypriot government announced the terms. All bank deposits would be taxed. Accounts under 100,000 euros, 6.75% levy. Accounts over 100,000 euros, 9.9% levy. The total would raise approximately 5.8 billion euros. Combined with the Troika's 10 billion, Cyprus would have the funds to stabilize the banks. The reaction was immediate rage. Cypriots couldn't access their money, banks were closed for the weekend. ATMs became battlegrounds as people tried to withdraw whatever they could before the levy hit. Lines formed at every machine across the island. People who normally never used ATMs were panic withdrawing. Families sent multiple members to different machines to maximize withdrawals before limits kicked in or cash ran out. By Saturday afternoon, many ATMs were empty. The banks had closed Friday with normal cash reserves expecting a normal weekend. They weren't prepared for the entire island trying to withdraw simultaneously. Once an ATM emptied, it stayed empty. Banks were closed. No armored cars were refilling machines. The cash that was out was out. Everything else was trapped. Those who managed to withdraw felt lucky but terrified. They had cash, but for how long? What if banks stayed closed for weeks? What if the levy increased? The initial proposal was 6.75 to 9.9%. What if Parliament raised it to 20%? 30%? If the government could confiscate 10% of deposits, what stopped them from taking more? Those who couldn't withdraw faced helpless fury. Their money was in the bank. They could see the balance on their account statements or online banking, but they couldn't touch it. The government had announced a tax on their deposits, and they couldn't even withdraw the money before the tax hit. It was theft with a legal veneer. Protests erupted. Cypriots gathered outside banks that wouldn't open. Outside Parliament, outside the presidential palace. The anger wasn't just about the money, it was about betrayal. People trusted banks because governments guaranteed deposits. The EU promised deposit insurance up to 100,000 euros. That promise was being broken explicitly. If governments could break deposit insurance, what other promises would they break? European officials tried to calm fears. This was a special case, they insisted. Cyprus was unique. The banking sector was too large, too much Russian money, too much Greek bond exposure. It wouldn't happen in Spain or Italy or Portugal. Depositors in other countries shouldn't worry. But depositors were worried. If it could happen in Cyprus, why not elsewhere? Spain had a real estate crisis. Italy had massive government debt. Greece was still unstable. Any of these countries could face banking stress. And now there was a precedent: tax deposits to avoid taxpayer bailouts. Every depositor in Southern Europe started questioning whether their money was safe. The proposed levy violated a fundamental principle: deposit insurance. The European Union had deposit insurance guaranteeing accounts up to 100,000 euros. Every EU country promised depositors this protection. The Cyprus proposal taxed insured deposits. It broke the guarantee explicitly. If you had 50,000 euros, well within the insured limit, you would lose 6.75%. Over 3,000 euros confiscated from an account the EU promised to protect. Cypriot politicians balked. The levy required parliamentary approval. Cypriot Parliament wasn't going to vote for political suicide. Taxing insured deposits would destroy any politician who supported it. The vote was scheduled for Tuesday, March 19th. Nobody expected it to pass. It didn't. On March 19th, the Cypriot Parliament rejected the deposit levy overwhelmingly. 36 voted no, 19 abstained, 0 voted yes. The proposal was dead, but the crisis wasn't solved. Cyprus still needed 5.8 billion euros. The Troika still demanded contribution from Cyprus. The banks were still insolvent, and now the entire world was watching. Depositors in Cyprus and across Europe were terrified. If the government could propose confiscating 6 to 10% of deposits, what would they actually do? Negotiations continued frantically. Cyprus proposed alternatives: pension fund raids, privatizations, National Solidarity Fund. None raised enough. The Troika wouldn't budge on the total required. Cyprus had to find 5.8 billion. The final deal was worse than the initial proposal for large depositors. Announced March 25th, implemented when banks reopened March 28th. The terms: Bank of Cyprus, the largest bank, would be recapitalized through a deposit bail-in. Accounts under 100,000 euros, fully protected, zero loss. Accounts over 100,000 euros, 47.5% confiscated, not taxed, converted to bank equity. If you had 200,000 euros, 100,000 was protected. The other 100,000, you kept 52.5% in cash, 52,500. The other 47.5%, 47,500, became shares in Bank of Cyprus. Shares in a bank that had just failed. Shares worth pennies eventually. Laiki Bank, the second largest bank, was worse. Liquidated entirely. Accounts under 100,000 euros were transferred to Bank of Cyprus and protected. Accounts over 100,000 euros? Total loss initially, though eventually some small recovery. If you had money in Laiki above the insured limit, you effectively lost it all. The math for large depositors was catastrophic. If you had 500,000 euros in Bank of Cyprus, the breakdown: 100,000 protected, 400,000 subject to bail-in. You lost 47.5% of the 400,000, 190,000 euros confiscated. You kept 100,000 protected plus 210,000. What remained of the 400,000 equals 310,000 total. You lost 190,000, 38% of your total deposits, gone. And that assumes you could access the remaining money. When banks reopened March 28th, capital controls were in place. The restrictions were comprehensive and suffocating. Daily withdrawal limits, 300 euros. Whether you had 1,000 euros or 1 million euros in your account, you could withdraw 300 per day, period. If you needed 5,000 euros to pay a supplier, too bad. You'd need 17 days of maximum withdrawals to gather that much cash. And that's assuming you could withdraw every single day without missing one. Monthly transfer limits abroad, 5,000 euros initially, later raised to 10,000 but still crippling. If you wanted to move money out of Cyprus to a safer jurisdiction, which everyone rational wanted to do, you faced hard limits. A Cypriot business importing goods from Germany couldn't wire payment freely. Permission required, approval needed, delays inevitable. Credit and debit card restrictions. Using Cypriot cards abroad became complicated. Limits on how much you could charge. Restrictions on cash advances. The cards worked domestically, but internationally they were crippled. Cypriots traveling abroad found their financial tools suddenly unreliable. Check writing restrictions. Large checks required special approval. If you wanted to write a check over a certain amount, initially around 5,000 euros, you needed permission from authorities. Every transaction scrutinized. Your money, but you needed government approval to spend it. Business payments required documentation proving the transaction was legitimate. Cypriots couldn't just wire money to a business partner abroad. They needed invoices, contracts, proof of delivery. Every transfer was investigated to prevent capital flight disguised as business transactions. The bureaucratic burden was massive. Simple transactions that took minutes before now required hours of paperwork and days of waiting. These controls were supposed to be temporary. Just until the situation stabilizes, authorities promised. But temporary became weeks, weeks became months. Some restrictions lasted over 2 years. The €300 daily limit was eventually raised, but slowly. Controls were relaxed gradually over years, not months. And some controls, particularly on large transfers, remained in place far longer than anyone expected. The effect was economic suffocation. Businesses couldn't operate normally. International trade became difficult. Foreign investment fled. Who wants to invest in a jurisdiction where you can't get your money out? Tourism suffered. Tourists heard about ATM limits and capital controls and chose other destinations. The economy contracted sharply. GDP fell by double digits over 2 years. Unemployment spiked above 15%. The bail-in saved the banks but destroyed the economy. When the London gold pool closed in March 1968, there was no warning. Investors woke up and the market was locked. No gold available, no conversion, done. We created the 7-stage collapse survival guide so you never get trapped when the window closes. It shows you exactly when to move your wealth into assets that survive collapse, before banks freeze, before governments confiscate, before inflation devours your savings. While you can still access it at https://pay.hotmart.com/B1033628817E. The Cyprus bail-in shattered trust in banking across Europe. If it could happen in Cyprus, it could happen anywhere. Depositors in Spain, Italy, Greece, Portugal, countries with banking stress, started questioning whether their deposits were safe. The European Central Bank and European Commission insisted Cyprus was unique, a special case, an island with oversized banks and Russian money. It wouldn't happen elsewhere. This was a lie. Even as they said it, European authorities were finalizing the Bank Recovery and Resolution Directive, BRRD, which made bail-ins official policy across the EU. The directive, implemented in 2016, explicitly allows authorities to bail in deposits over €100,000 during bank failures. Cyprus wasn't an exception. It was the pilot program. The BRRD established a hierarchy for absorbing losses when banks fail. First, shareholders are wiped out. Then bondholders take losses. Then large depositors, those with over €100,000 or the equivalent insured limit. The protected depositors under $100,000 are supposed to be safe, but Cyprus proved that supposed to be isn't a guarantee. When the crisis is severe enough, even insured deposits can be targeted. The United States adopted similar frameworks. The Dodd-Frank Act includes provisions for orderly liquidation authority, allowing FDIC to resolve large banks through bail-ins if necessary. Depositors above the insured limit, $250,000 in the U.S., are explicitly at risk. The FDIC has published papers discussing deposit bail-ins as a resolution tool. It's not theoretical, it's planned. The UK has the Banking Act allowing similar measures. Canada updated its budget in 2013, the same year as Cyprus, to explicitly include bail-in powers for failing banks. The language is careful. They don't call it confiscation, they call it recapitalization or resolution. But the effect is identical. Your deposits are converted to equity in a failing bank, and you lose most or all of your money. Cyprus proved several things. First, that governments will confiscate deposits when banks fail, and bailouts are politically unacceptable. The 2008 financial crisis saw massive taxpayer-funded bailouts. Public anger over bailing out banks with taxpayer money created political pressure to find alternatives. Bail-ins are the alternative. Instead of taxpayers funding bailouts, depositors absorb losses. Politically, this is easier to sell. Why should taxpayers rescue reckless bankers? Make the people who use those banks pay. Second, Cyprus proved that deposit insurance isn't absolute. The initial proposal explicitly taxed insured deposits. Even the final deal only protected insured deposits because of political outcry. If the crisis had been worse, if the Troika had demanded more, insured deposits might have been hit anyway. The lesson: deposit insurance is a political promise, not a guarantee. Promises can be broken. Third, Cyprus proved that capital controls can be imposed instantly and last indefinitely. The €300 daily withdrawal limit remained in place for weeks. Some controls lasted months. Years later, certain restrictions remained. Once imposed, capital controls are difficult to remove. They become normalized. and they trap wealth inside a jurisdiction where it can be further confiscated through inflation, taxation, or additional bail-ins. Fourth, Cyprus proved that bank holidays can be extended far beyond what seems reasonable. 12 days, nearly 2 weeks without access to your money except through ATMs that ran dry. If you needed to pay rent, buy groceries beyond cash on hand, transfer money for emergencies, too bad. The banks were closed, your money was inaccessible, and there was nothing you could do. For Cypriots, the practical effects were devastating. Businesses couldn't pay suppliers, employees couldn't be paid except in cash. Tourism collapsed. Who wants to vacation in a country where you can't access money? Capital flight was immediate once controls allowed limited transfers. Anyone who could get money out of Cyprus did. The economy contracted sharply. GDP fell, unemployment spiked. It took years to recover. For Russians who had deposited billions in Cyprus, the losses were massive. Estimates suggest Russian depositors lost 4 to 5 billion euros in the bail-in. The breakdown varied. Some Russians had pulled money out before the crisis hit. Those who saw the Greek bond exposure and got nervous in late 2012 managed to exit. But many stayed. They trusted Cyprus, EU member, Eurozone country. How bad could it get? Very bad. Russians with accounts over 100,000 euros at Bank of Cyprus lost 47.5%. Russians with accounts at Laiki Bank lost nearly everything. The Russian government estimated total Russian losses at 3 to 4 billion euros, possibly higher. For context, that's a significant fraction of Cyprus's entire GDP. Russian wealth built up over 2 decades in Cypriot banks was wiped out in 2 weeks. Some of these depositors were legitimate business people. Russian companies doing international trade used Cyprus as a financial hub. Money earned in Russia was transferred to Cypriot banks for easier access to European markets. These businesses lost working capital they needed to operate. Legitimate commerce suffered. Some were wealthy individuals diversifying assets. Russian entrepreneurs who built successful businesses and wanted wealth outside Russia chose Cyprus. Better legal system than Russia, EU protections, or so they thought. These individuals saw their savings confiscated. And some, probably many, were engaged in money laundering, tax evasion, or hiding wealth from Russian authorities. Oligarchs close to Putin, organized crime figures, corrupt officials, Cyprus offered secrecy and EU legitimacy. Perfect for cleaning dirty money. The bail-in effectively confiscated wealth that Russian authorities wanted to seize but couldn't reach. In a twisted way, the Cyprus bail-in did what Russian law enforcement had tried and failed to do for years. Putin was furious publicly. He called the proposed deposit levy unfair, unprofessional, and dangerous. Russia offered Cyprus alternative financing to avoid the Troika deal, a loan from Russia to replace the European bailout, but the terms weren't generous enough or weren't acceptable to Europe. The Russian offer was rejected. Russia-Cyprus relations soured dramatically. For decades, Cyprus had been Russia's favorite European offshore haven. Russian tourists filled Cypriot beaches, Russian money filled Cypriot banks, Russian businesses registered Cypriot subsidiaries. That relationship was destroyed. Russians pulled remaining money out as soon as capital controls allowed. New Russian money stopped flowing to Cyprus. The offshore haven model collapsed. The geopolitical implications were significant. Cyprus had been a neutral EU member friendly to Russia. After the bail-in, Cyprus aligned more closely with European interests and distanced from Russia. The economic dependence on Russian money was revealed as dangerous. Diversification became policy. The island that had welcomed Russian oligarchs now sought tourists and investors from elsewhere. For European policymakers, the Cyprus outcome was mixed. On one hand, they avoided a taxpayer-funded bailout. No German or French taxpayer money went to rescuing Cypriot banks directly. The Troika's 10 billion euros was a loan, not a grant. Cyprus contributed 5.8 billion through the bail-in. Politically, this was defensible. We made the people who used risky banks pay, not you. On the other hand, they shattered confidence in banking across southern Europe. Depositors in Spain, Italy, Portugal, Greece looked at Cyprus and thought, that could be us. Bank runs didn't materialize immediately, but the fear was real. Money quietly moved from weaker banks to stronger banks, from southern European banks to German and Dutch banks. The periphery weakened further. The European Central Bank had to provide massive liquidity support to prevent contagion. Mario Draghi's "whatever it takes" promise from 2012 was tested. The ECB flooded the system with cheap credit to ensure Spanish and Italian depositors didn't panic. It worked. Contagion was contained, but the cost was embedding moral hazard even deeper. Banks knew the ECB would provide unlimited liquidity to prevent runs. Risk-taking continued, but the broader impact was the precedent. Cyprus established that bail-ins are acceptable, that depositors are creditors who can be forced to absorb losses, that capital controls are a normal crisis response, that bank holidays can last as long as needed. Every one of these tools is now part of the standard playbook for banking crises. The next crisis won't see governments scrambling to invent solutions. They'll implement the Cyprus blueprint, banks will close, capital controls will be imposed, deposits over the insured limit will be bailed in, maybe even deposits under the limit if the crisis is severe enough. It will happen faster and more smoothly because the legal frameworks are already in place. For individual depositors, Cyprus teaches a brutal lesson. Bank accounts are not safe storage for large amounts of wealth. If you have significant savings above the insured limit, you are an unsecured creditor of the bank. When the bank fails, you lose. The government will not bail you out. They will bail you in. Diversification becomes essential. Holding all your wealth in bank deposits in a single jurisdiction is insane after Cyprus. Spreading deposits across multiple banks, multiple countries, multiple currencies reduces the risk that a single bail-in wipes you out. Physical assets, real estate, precious metals, goods can't be bailed in. They can be taxed or confiscated through other means, but they're not trapped in a bank account subject to instant haircuts. Cyprus also shows why having access to funds outside the banking system matters. When capital controls hit, electronic money is trapped. Cash provides freedom. Gold provides portability. Cryptocurrency, though controversial, provides an option to move value outside traditional banking. The specific solution matters less than the principle. Don't keep everything in banks. The timing of Cyprus was significant. March 2013 was still relatively close to the 2008 crisis. Memories of bank failures and bailouts were fresh. Public anger over taxpayer-funded rescues was high. Politicians wanted to avoid another TARP-style bailout. Bail-in seemed like a solution that punished the right people, bank creditors and large depositors rather than taxpayers. But the decision ignored a fundamental reality. Most people over the insured limit aren't billionaires. They're small business owners with working capital, retirees with life savings, middle-class families who save for decades. A Cypriot with 200,000 euros isn't wealthy by global standards. They're prudent savers, and they lost 47.5% overnight. The injustice was staggering. The European authorities justified it with cold logic. Banks failed. Someone has to pay. Taxpayers already bailed out Greece. Cyprus can't expect the same. Depositors used the banks, benefited from high interest rates offered by risky institutions. They should bear the losses. This logic treats depositors as sophisticated investors who understood and accepted risk. But most depositors aren't sophisticated. They trusted that bank accounts were safe. That trust was betrayed. The aftermath saw minimal accountability. Bank executives who made catastrophic investment decisions loading up on Greek bonds faced few consequences. Government officials who oversaw the bloated banking sector remained in office. The people who lost money were ordinary Cypriots and foreign depositors who had no role in creating the crisis. The people who caused it largely escaped unscathed. This pattern repeats in financial crises. Those responsible avoid consequences. Those who trusted the system suffer. Cyprus codified this into policy. The bail-in framework ensures that when banks fail, depositors, not bankers, not regulators, not politicians, absorb the losses. It's efficient, it's legal, and it's coming to every major jurisdiction eventually. The calm reassurances from authorities that this won't happen here are worthless. They said it wouldn't happen in Cyprus either. Then it did. They said deposit insurance was sacred. Then they proposed taxing insured deposits. They said capital controls were temporary. Then they lasted years. Every promise made during a crisis is subject to change when the crisis worsens. March 16, 2013 was the day banking changed. Deposits became bail-in-able. Capital controls became acceptable. The sanctity of bank accounts, the idea that your money is yours and governments can't just take it, died. And the mechanism used in Cyprus is now law across the developed world, waiting to be triggered when the next crisis hits. This is decoded economics. Subscribe to see the confiscation before it happens.